Welcome to this video. We are in the series of Guide to International Business, Introduction to Trade Finance and Working Capital. Trade Finance as Working Capital. Now, trade finance plays a crucial role in managing the working capital for the business, where the business is engaged in cross-border trade. This overview tries to look at how these trade finance instruments or the strategies or the tools and techniques or the methods can be leveraged to optimize working capital management. We will look at the concepts, the benefits, the challenges, and the mitigation methods. Trade finance refers to the financial instruments and services that facilitate international trade offered by financial institutions. The working capital management involves optimizing the balance between the company's current assets and current liabilities to ensure smooth operations and to ensure financial stability. Now, trade working capital is the difference between the current asset and current liability directly associated with everyday business operations in international trade. That is, the assets and liabilities related to cross border trade. It represents the funds available to the company to finance its short term liabilities activities. What's the importance of trade finance in working capital management? It is expected to provide liquidity. It is supposed to mitigate the risk associated with cross border trade. It should optimize the cash flow cycles, the time when you pay for your purchases versus the time when you get paid for your sales. And the trade finance working capital management is supposed to enhance the financial flexibility of the business. The key components are there are several instruments and several strategies that contribute to the working capital management. The most important of them, or the most popular of them, is the letter of credit. The letter of credit is complex in terms of documentation and potential for discrepancy. And if there is a careful negotiation at the time of order and preparation of the letter of credit, then the documents can be prepared suitably to ensure correct payment on the right time. The second instrument is the supply chain finance methodology, where one can ensure suppliers receive yearly payments through a third party stepping in to fund. The challenge is that how do we onboard the suppliers onto a platform? How do we balance the needs of the buyers and credits? But the new latest state of art technology platforms and flexible financing options can handle that. Receivable finance is a method where factoring or forfeiting or invoice discounting can be carried out, and then that will help in saving not only the fees but also provide as an alternative to traditional trade finance methodology. Inventory finance helps to finance the raw material inventory as well as the finished goods inventory. Also, suppose you are a commodity trader and if you are using inventory finance, you can secure funding against the metals or the oils or the grains that you have stored. The risk is that the prices will go up and accordingly a collateral recovery will be more or less. But at the same time, you will have an opportunity to sell when the price of the commodity goes up. So valuation is a challenge, but valuation of the inventory itself is a benefit. The requirement will be to implement a robust inventory management system. Now, what are the benefits of having a trade finance for working capital management? The most important of them all is the improvement in the liquidity. These instruments provide access to liquidity to the corporate at the various stages of the trade cycle, be it you procuring the raw materials or converting them or selling them and waiting for the receivable to mature. The improvement in liquidity is to enable the business to meet the short term obligations or even invest the excess in the growth opportunities. The second benefit is risk mitigation because these instruments have various features such as credit insurance or a payment guarantee and reduce the risk of default. It also provides an opportunity for extending the payment terms. That is, the suppliers can utilize the instruments provided by the banks and financial institutions to provide longer payment term to the counterparty without negatively impacting the suppliers. Accelerated cash conversion is nothing but discounting or prepayment of the receivables or inventory financing. So these are the various benefits. Now there are challenges in using trade finance as a working capital management tool. Most important of them is the complexity of the cross-border trade because it involves multiple parties, multiple regulations, lots of document requirement. The discrepancy may fail to get the payment on time, and these are the complexities. So investing in expertise, getting trained, being updated of the latest developments is the best way. One. Two is to manage the currency risk by way of hedging or options, forwards, etc., or a natural hedge or a multi-currency balance sheet. Third is ensuring regulatory compliance, that is, manage the diverse requirements of different jurisdictions by way of continuous update of information. Fourth is implementation of technology solutions, facilitate integration, adopt a blockchain or AI or e-banking methods, ensuring the ERP is integrated via API to other systems. All those things can be done to make the information real time, online, easy, efficient, and correct. What strategies can be used? Now, strategies that can be used are to have an holistic approach to the working capital management. That is to get a comprehensive view of the entire working capital cycle of the company as well as the subtunnel view of the cross border trade portion, the interplay between the payables and receivables and the stock on hand. Second is the leveraging technology for data analytics because it will provide real time visibility into the metrics. It will provide opportunity to identify optimization situations. Then we can implement dynamic discounting. That is, you will discount whenever you have a shortfall, but whenever you are cash rich, you will not be paying interest and discounting it. So early payment will be selective, and accordingly, the rate of interest will be different according to the outstanding tenor of the receivable. Shorter the tenor, easier you will be able to get the finance and overcome situation at the same time not pay interest in a high rates. Optimizing inventory management is also important because you don't have to unnecessarily hold raw material or finished goods. This will come with advanced inventory management techniques, just in time methods, etc. Diversifying funding sources is an important benefit that comes from because working capital can be financed in hundreds of ways, trade finance is one another way. So, a mid sized exporter can combine normal bank finance with the trade finance capabilities and alternative financing option like factoring and forfeiting and supply chain and thereby meet the working capital needs. Now, let us turn our attention to the trends in working capital management for trade finance. One is digitization and blockchain, so that transparency, security, speed, everything is improved. Next is sustainability, because if the transaction is proved to be meeting the ESG goals or the UN SDG goals, then you will get finance at the concessional rates. Third is using artificial intelligence for analytics, risk management, fraud detection, and thereby create an optimization in your cost of working capital. Then comes using banking APIs for integration or open banking. This will help to access multiple platforms and get the best rate for the right period at the right time. So these are the various aspects in which working capital can be used. There are different case studies that is possible to understand this. For example, if you are a large global retailer and if you have a supply chain program, then you can optimize your working capital and you can support your suppliers. How do we do? We integrate the ERP with the bank's system. We can have a tiered financing rate based on the size of the party and the relationship depth. We can have different suppliers having option to choose early payment or extended terms, and thereby what happens is you may get reduction in the working capital requirement. You will get an improvement in the cash conversion cycle. The earlier it will get converted, so the date sales outstanding or days payable outstanding DPO DSO will come down. And then what do we understand from this? The using of supply chain as an alternative finance for working capital, what we get is clear communication between the parties, and with the bank to properly structure the program will bring lots of benefits to every entity. Using robust technology will help scalability and instant data availability. And then the flexibility of the program to meet the different parties' needs will make adoption easy. So this is one of the ways in which the various trade finance financing methods can be used to enhance the working capital requirement. To conclude, adopting a holistic approach, leveraging technology, enhancing visibility, making the decision making easy, diversifying the funding sources, bringing in flexibility and resilience into the working capital, staying informed of the new trends, innovating in system and methods, and balancing the needs of the stakeholders. These are the various ways in which trade finance can be used for augmenting the working capital. Thanks for watching this video. We will catch up again on another video on international trade and financing.